Welcome back to The Explainer. Today, we're unpacking a week where global geopolitics and local realities basically violently collided. We're looking at the news cycle from July 21st to the 25th, 2026, and we're going to trace these massive global shockwaves right down to how they actually affect our domestic daily life. Seriously, this is one of those rare moments where everything connects. Okay, let's dive right into this. Financial analysts across the board are pointing to this past week as literally one of the most consequential macro weeks since the 2022 inflation surge. We've got colliding forces across defense, technology, and global trade, and the sheer velocity of the news, it's staggering. We aren't just looking at a few isolated events here, we're looking at a fundamental rewiring of the global economic outlook. So here is our roadmap for making sense of it all today. First up, geopolitics, tariffs, and war. Second, big tech's capex reckoning. Third, the defense boom and market shifts. Fourth, we'll cover extreme heat and diversions. And finally, number 5, what to watch next week. Let's get into it. Starting off with Section 1, geopolitics, tariffs, and war. Right now, there are twin macroeconomic anchors pulling heavily at the very fabric of international trade and stability. And the first anchor is represented by this frankly staggering figure, $37.5 billion. That is the financial cost so far in U.S. taxpayer money of the ongoing Iran war. The U.S. continues its military buildup in the Middle East following those Houthi tanker attacks, and as of this week, there's absolutely no publicly announced cap or exit strategy for the spending. None. The second anchor is global trade policy. The Trump administration just rolled out sweeping new tariffs of 10 to 12.5% that hit 60 major trading partners pretty much overnight. The sheer scale of this action is historic, and it's introducing massive new friction into the entire global supply chain. And when you combine an expanding war with sweeping tariffs, you get this, $100. Brent crude oil peaked at $100 a barrel this week for the first time since May. Now, it did pull back slightly to just below $95 on Friday after a Reuters report singled some Pakistan-China diplomatic efforts to restart peace talks. But that massive weekly gain in energy costs is already rippling through the economy. You are absolutely going to see it at the gas pump soon. Behind those massive financial figures, though, is a grave human and diplomatic reality. Seatoncom just completed its 13th consecutive night of strikes. Iranian health authorities report 59 people killed and 666 wounded since hostilities resumed on June 27th. On the U.S. side, the Pentagon confirmed 4 additional service members have died, which brings the cumulative American toll to 21 since February. Diplomatically, while Pakistan and China are exploring paths to restart negotiations, Iran has aggressively disputed a New York Times report claiming they rejected a U.S. ceasefire proposal, calling that report diversionary. So the human cost is escalating while diplomacy stalls. On the policy front, let's objectively look at the mechanics of these new global tariffs taking effect this Friday. These 10 to 12.5% levies on 60 countries represent the largest tariff action since the Supreme Court struck down prior levies in February. To actually implement this, the White House is citing forced labor as the legal justification. It's a Supreme Court workaround that has immediately drawn intense legal scrutiny and debate from critics. But regardless of that debate, the economic reality on the ground is that these tariffs are now active. Moving on to Section 2, Big Tech's CapEx Reckoning. Now, what's really interesting about this slide is how we pivot from global policy to the immediate shockwaves hitting the stock market. The darlings of the last few years are suddenly facing some really intense scrutiny. Just notice how broad this reevaluation of growth stocks has become. Tesla and Alphabet together shed roughly $500 billion in combined market capitalization this week alone. Why? An AI capital expenditure shock. Investors are just terrified by the ballooning costs required to build out AI infrastructure. And it's dragging down other former market darlings too. Take SpaceX, facing broader growth stock reassessments and these hyperscaler capex concerns, they just hit an all-time low, down 31% from their June IPO peak hit. Section 3, Defense Boom and Market Shifts. And this brilliantly illustrates a key market dynamic. Capital doesn't just disappear, right? It rotates. So while $500 billion evaporated from tech over AI spending fears, defense contractors just posted their absolute best week of 2026. Lockheed Martin surged over 10% on a record $230 billion backlog. They've got new orders coming in at 3.2 times quarterly revenue, driven directly by the Iran war. Meanwhile, legacy tech is finding its footing again. Intel delivered a massive blowout quarter, doubling earnings estimates and showing a 59% year-over-year jump in data center and AI revenue, hitting critical yields on their 18A foundry node. So it's vital to keep the big picture in mind here. Despite the high-profile tech route dominating all the headlines, notice the massive segment here.
An incredible 88% of reporting S&P 500 companies have actually exceeded their earnings per share estimates. Overall earnings growth for the S&P 500 is tracking at a massive 24.7% year over year. The underlying engine of the market remains remarkably strong, even as capital aggressively shifts between sectors.
All right, part 4, extreme heat and diversions.
Let's bring the narrative back down to the ground level for a second. How are consumers actually navigating this macro chaos? Because geopolitics isn't the only thing running hot right now. A dangerous, high-pressure heat dome is blanketing much of the United States. Down in the Dallas-Fort Worth metroplex, dissipating moisture from Tropical Storm Bertha is adding this suffocating humidity, pushing the feels-like temperature to 107 degrees. Out in the Permian Basin in Odessa, we're seeing actual temperatures approach 105. And this footprint is expanding, with the Pacific Northwest heat event shifting aggressively east into the Montana and Dakotas corridor by Saturday. You know, when the news cycle is this heavy and stepping outside feels like an absolute oven, people naturally turn to their screens for a little diversion. The American League won a highly rated MLB All-Star game this week, with Bobby Witt Jr. taking MVP honors. In soccer, Argentina officially confirmed the international retirement of 39-year-old Lionel Messi following their World Cup final defeat. And speaking of that World Cup, it drew 60.3 million viewers. That is setting Fox Sports up for a record Q2 broadcasting quarter, and it's giving them massive leverage as they enter the 2030 FIFA rights negotiations. But the reality is, even our entertainment isn't immune to these macro ripples. The $11 billion Paramount and Warner Bros. Discovery merger is facing a critical August 4th hearing. But regardless of how that legally shakes out, both studios are having to navigate a suppressed ad market. The combination of $100 oil, war, and rising recession fears means advertisers are just pulling back on their commitments. Even streaming giant Netflix shed roughly 12% this week, ahead of an earnings-free weekend. The macro environment is literally dictating everything. Let's move to our final section and see how this builds into next week. What to watch next? With all these forces in play, the horizon is incredibly stacked. Here are the critical upcoming events that will serve as the definitive follow-up to this week's chaos. On Tuesday, we've got the Federal Reserve rate decision. Wednesday brings the vital PCE inflation data. And later in the week, that AI CapEx storyline we talked about continues as Microsoft, Meta, and Apple all report their Q2 earnings, right as Amazon kicks off Prime Day. It is going to be a massive week. So the crucial point is this ratio right here, 1 in 3. Just a week ago, the odds of a Fed rate hike next week were sitting at a mere 12%. Today, driven directly by the twin shocks of $100 oil and those sweeping new global tariffs reigniting inflation fears, those odds have surged to a 1 in 3 chance. The bond market is aggressively digesting these new geopolitical realities as we speak. Which leaves us with one overarching question to chew on. As war expands, as these new tariffs hit, and as extreme weather strains the grid, how exactly will these colliding forces reshape the global economy heading into Q3? The ripple effects of this week are really just the beginning. Keep a close eye on big tech earnings and the Fed's tone this Tuesday, because the answers to this puzzle are unfolding in real time. Thanks so much for joining me on this explainer, and keep learning.